All right, let me begin with some facts, just to give you context. There's, and I'm rounding, obviously. There are $10 trillion in mortgages outstanding. Total mortgage debt outstanding is about $10 trillion. Just for context, the municipal bond market is almost $3 trillion. There's 10 trillion or so in publicly traded U.S. Treasury debt, about 10 trillion in corporate bond debt. So it's a big market, big part of the market. Of the 10 trillion, almost half, 5 trillion is Fannie Mae, Freddie Mac. They stand behind about 5 trillion. Another trillion or so is FHA, VA, USDA loans. So that's those are government loans. About $1 trillion is what are known as private label securities. These are purely private mortgages that have been packaged and sold as securities. This is subprime, Alt-A, jumbo mortgages. We can talk about what these things mean, but it's private market. That leaves about $3 trillion, and those are mortgages that the banks own. They're sitting on the bank's balance sheet. Another way of looking at it, there's 7 trillion of the 10 trillion is securitized. That is, mortgages have been bundled and securities issued based on those mortgages. 3 trillion is in just whole loans, mortgages that mostly sitting on the bank's balance sheet. There's 115 million households, 75 million are homeowners, 48 million have mortgages, 8 million are underwater, meaning they owe more than the home is worth. There's 2.25 million that are in foreclosure or pretty close. They're 90 days and over delinquent. Kind of gives you context. Just to give you a sense of the losses in the crisis. So if you total up all the losses on mortgages between 2006 and 2012, so this is the collapse, the recession, the Great Recession, the financial crisis. The total loss on mortgage debt was about 8%, so 8% was wiped out of the value. The mortgages were wiped out. That's through foreclosure, and then the loss when the home is sold in foreclosure. Fannie Mae and Freddie Mac losses were 3%. So 8% was the average across all the market. Fannie and Freddie were 3%. And that's also maybe 3.5% if you include the private mortgage insurers, because they provide some support to Fannie and Freddie loans. Losses on FHA loans was 17%. Losses on the loans sitting on the bank's balance sheet was about 6%, 7%. Losses in the private label securities market, that's subprime, Alt-A, that was over 20%. To some degree, the script is still being written here, right? So all the losses aren't completely in, but we're getting pretty close to the end of the process here of cleaning out all the bad loans that were made during the boom in the bubble. Any other fun facts you'd like to know?
What's a normal, like in normal times, what is a normal foreclosure rate? Now you're talking about 3% on Fannie Freddie,
Yeah, so I said there are 2.25 million homes that are in foreclosure or 90 days plus. Mm-hmm. In a normal market, 750,000, maybe 1 million, something like that. Just for context, though, at the worst of the crisis, if you go back to late 2009, early 2010, there was 4.5 million loans in foreclosure or pretty close. So we've come a long way, but we're not all the way back. And this last bit is going to be very slow because a lot of it's sitting in states that have judicial foreclosure laws, and the loans are tied up in the judicial process. So New York, New Jersey, Connecticut, Florida, those states account for the bulk of the loans that are sitting in foreclosure. And the rest of the country, we're probably back to normal in many cases. California's back to normal. Arizona's probably back to normal. North Dakota's never been normal, so one loan in I'd be surprised if there's any loans in
No,
foreclosure.
not in North Dakota.
Would it be possible at some point to talk about sort of the little pockets where there's still a lot of underwater property? I was thinking of doing a story about eminent domain and how serious of an issue that is.
Yeah, so the 8 million or so folks that are underwater, the highest negative equity is still in some of the bus states like Nevada, parts of Florida, Central Valley of California, so that's where a lot of the eminent domain actions are occurring. And then, interestingly, a lot of Midwest, Detroit, Cleveland, that area, and then a lot of kind of rural ex-urban areas where you always have a lot of underwater homeowners because you don't get a lot of price growth. So in a normal level of negative equity, there's about 2.5 million homes underwater. So even if you go back to 05, 06 in the peak of the bubble, there were still a couple million people that were underwater, right? They're sitting in West Texas, or put very little down, but there's no price, or upstate New York, a lot of always underwater homeowners, or pretty close, there's no price growth.
The outer rings, like the outer sprawl. So there's no pressure. There's no pressure on prices. But does everybody understand the eminent domain issue, or what generally it is? So there's efforts by some localities and states to try to get ahead of some of these foreclosures and the underwater property issue. Tell me if I'm getting this wrong. And they've come up with, I think, a kind of a novel legal approach, and that is, we've all heard about eminent domain of actual real estate, real property, where the state comes in and says, we're going to take this for the public good. Kelo, go look at your Kelo Supreme Court case. That lot's still empty. And what they've done, what they're trying to do now is say, we're going to do eminent domain on the actual financial instrument that is on your piece of property, so not the actual real property itself. And I think this is this unique, or is this a first time thing?
I've never heard of it before.
Was a
Yeah.
professor at Cornell who was a paper that's sort of the foundation of this.
Yeah.
And he claims that it's well established that these contracts are, that a city can do eminent domain on these contracts just as well as on real property.
I don't think that's true. I don't think that's well established.
Yeah.
There's a very good New Yorker article on this. It's sympathetic to this idea, but it takes you through, it's very readable.
And it's important because, of course, it affects the financial markets, right? It's the government's wanting to take not the real property, but the financial instrument at cut, on the cheap. So Wall Street's worried.
So can I ask you about that? So let's say I have a house in Central Valley of California, and I'm underwater by $50,000, and the city or county comes in with eminent domain and takes that underwater mortgage, right?
Mm-hmm.
What do they do with it then?
They, for the public good, they don't want you to be underwater, right? So they're going to refinance your loan or write better terms on your loan to make you able to pay, easier for you to pay and to make you not underwater. So they might forgive some of the loan, for example,
But
right?
in the particular cases that are being, in the news, there's a company. It's basically a bunch of Democratic donors.
Yeah.
You can basically search their names, and you'll find all these photos of them hosting fundraisers. And the idea is that they're going to buy it, right? So they're going to buy the loan and then restructure it, right? So do all the things that Lorraine said, and then refinance it. And if I have it right, their financing plan is to do it through FHA. Now FHA has said we're not sure we're going to take this. They haven't said no, but they haven't said we're sure we're going to do this. But then the homeowner would come out ahead, right? They used to owe, right? The water used to be above their head, and now it's below their nose or below their mouth, so they're fine, in terms of staying in the home. And the company is MRP, Mortgage Resolution Partners,
Yeah.
would take basically a cut of that, right? So, and of course, as you can imagine, right, the eminent domain process, right, it's in the Constitution, you're supposed to pay the fair value of the loan, and so there's a question of what's the right value, and how can they do this? How can MRP make a profit if they're paying the right amount for the mortgage?
So if I'm Wells Fargo and you just eminent domain a loan that I had, a
Mhm.
mortgage that I had financed, right, as
Yeah.
Wells Fargo, the government is now paying Wells Fargo what amount?
Less.
Well, that's the question, right? Like, we've all read, like, let's go back to real property. We've all read about fights over eminent domain. You guys want to take my house to build a school? You're gonna have to pay me a hell of a lot more than what you're offering. My land is worth more. And that's always the fight. So it's no
Yeah.
different.
But
What,
it's not gonna be Wells Fargo, though.
yeah,
Right, it'd be the
it'll be
investor.
appeal.
But yeah, we bought the investor. What's different here is that the cities that are doing this are saying, even though the face value of the mortgage is $300,000, and even though the homeowner is paying, this mortgage is actually a bad mortgage. It's not worth $300,000 because we have a computer model that says this mortgage is likely to go into default, and therefore it's only really worth $220,000. So we're going to pay you $220,000. And so that's the hard part. Is many of these are mortgages that are performing, people are paying, but the eminent domain people want to pay less on the basis of a forward-looking model that says it will default in the future.
Well, this is go ahead.
Yeah.
No, I was gonna say, and isn't this all having an impact on the loan process to new purchasers?
Yeah.
And the lending instruments?
Well, this is a good segue into, let's take a look at the who provides the mortgage credit. So, going back to the 10 trillion, 5 trillion is Fannie Freddie, 1 trillion is FHA, 1 trillion is private label securities, 3 trillion is banks. So let's focus on the private label securities in the context of eminent domain. The private label securities market is dead, right? There is no private label securities today. Just again, for context, if you go back to the boom back in the mid part of the last decade, the private label securities market was providing 1/3 of the mortgage credit. So if you go back to 2005, as an example, in the year 2005, private label securities investors, these would be, could be the BlackRocks and the PIMCOs of the world, a lot of other investors, foreign investors, provided 1/3 of the credit. Today it's zero. So there's no credit flowing from the private label market. There are many obvious reasons for that. I mean, one obvious reason is all the losses. Investors are very nervous about taking on any risk. Another reason is there's a lot of regulatory uncertainty. Not all the rules have been determined yet to allow the market to function. So, for example, there's a rule called QRM, Qualified Residential Mortgage. The QRM rule is the skin in the game risk retention rule that was part of Dodd-Frank. It says that if you issue a security, you have to own 5% of the security. You have to own 5% of the equity in the security. The thinking being that if you own a part of the security, you're going to be much more careful about the mortgages that go into the security, and you're going to make better loans. But that QRM rule is still being debated and has not been defined. And so that's a case of regulatory uncertainty that's keeping the market from starting. So another reason. A third reason, though, is potentially things like eminent domain, right? So eminent domain doesn't apply to Wells Fargo. They're not the ones who would get dinged by this. They're really concerned about the mortgages that are in the pools that back the subprime and all day. And so the investors would get dinged. And so investors, they gave money, they expect a certain amount of money back. If they get less than that, that's going to reduce their return, and therefore they're going to be much less likely to participate in this market going forward.
I'm sorry, this is a really dumb question, so I apologize in advance. Why is Wells Fargo issues mortgages, don't they?
Wells Fargo generally owns some mortgages. They keep them on their balance sheet. So if it's a mortgage that doesn't meet Fannie Mae and Freddie Mac guidelines, say it's in California, it's a big mortgage, so it's too large for Fannie Mae and Freddie Mac to buy, they will hold on to that mortgage. So they're making a boatload of mortgages in the San Francisco Bay Area, for example.
So why aren't they at risk of some of their mortgages having eminent domain?
Because they're not they made conforming loans, they made Fannie Mae, Freddie Mac loans. They did not make these loans that are still sitting out there that are in these pools.
It's just far less likely. It's highly unlikely that they'll be the ones that get hit.
Or if
They're
they
also
did.
very conservative then.
Yeah, it was more aggressive companies that are no longer with us. that were-
Countrywide?
Countrywide would be a good example. Yeah, Countrywide, which is now part of Bank of America, but Countrywide would be a good example.
But there's also politics. So I believe.
But can I just
yeah.
say, in all likelihood, B of A doesn't own those securities either, right?
Right.
It's other investors out there that own the securities now. It's not Countrywide. They made them, and then they sold them. So it's it could be it could be. It's generally not your blue chip pension fund that would invest in it, but there are investors out there, and a lot of hedge funds that are thinking, I can make money on this. I bought it at 50 cents on the dollar. Maybe I can get back 75 cents on the dollar, that kind of thing. But
Mark-
these investors are important for providing credit, right? They're providing capital to the mortgage market, and they won't do that in the future if they feel like something like this could happen to them. They could lose money.
It's not. But hasn't Ed DeMarco also said that Fannie and Freddie will be reluctant
Mhm.
to make loans in states
Yeah.
that go ahead with eminent domain?
Yeah, because they're afraid in the future that they could use eminent domain to stick it to Fannie Mae and Freddie Mac in the future. So there's some concern about the precedent this is setting and what it might mean for the future. And so even Fannie Mae, the FHFA, the regulator of Fannie Mae and Freddie Mac, has opined on this. Hasn't really stipulated anything, but has opined and said that this might be an issue for them in states that apply this rule. And FHA also, as Bill noted, is reluctant. Hasn't kind of weighed in either, but I'm sure they're very concerned about it also in terms of what it means for them. But the private label securities market is still dormant. There's nothing going on. Now there is a thought that, and a hope that the further we get away from the recession, the nightmare of the recession fades. Investors become more comfortable about the mortgages that are being made. The quality of the mortgages now are very different than the quality of mortgages being made back in the boom. That we nail down some of these regulatory issues, we get by some eminent domain issues, then the market will start to come back to life, and we'll see some credit flow from the private label securities market. But that's a very, very slow process and will take many years.
I don't know if I'm jumping ahead, but I'm just thinking out loud. When the market was hot and Fannie Mae was, and banks that were working with Fannie Mae were offering, low-income housing or 3% financing even before interest rates have come down the way they have come down, to try to get more people in a situation where they could purchase their own homes. Are we ever going to see anything like that again, or are those days gone?
I think they're gone.
So, back to his question, then what happens to the lower income or middle class person who would like to purchase a home?
Well, okay, so let's go on. We've covered the private label securities market, so that's a nice segue. I should take you everywhere with me. Let's talk about FHA, VA, and USDA. So that's the vehicle for providing credit, historically credit to lower income first-time home buyers. And if you go back to 2005, again, FHA was essentially not providing any mortgage credit. It was all coming from the private label securities market. Low-income households felt like they were getting a better deal from subprime lenders, right? Today, there is no private label securities market, so the FHA has filled the void, and the FHA today is providing 25-30% of mortgages. At the peak, back a couple of years ago, they were 35-40% of mortgages. So FHA is the vehicle for providing credit to this group. Now, you can still get a very low down payment loan through the FHA. You can get a loan if you have a low credit score, FICO score. You can get a loan from FHA if you have a very high debt to income ratio, meaning a high share of your income is going to servicing both your mortgage loan and other debt. So that is the principal vehicle for low middle income households. Now, there's some debate about whether they're providing enough credit, and they are raising the costs of providing that credit. They charge an insurance premium on the loans they make in case someone defaults. They need to cover that. And of course, they were in the news this week. They came out with a report saying they're still in their net worth is still negative, meaning their future liabilities are still a little bit greater than what they're going to collect in insurance premium. But to rectify that, they've raised the cost of their loans by charging a higher insurance premium. So it makes it more difficult for lower income households and first time home buyers. But that's still the main vehicle through which they are first time buyers and low income households get their loans. I think the typical credit score for a FHA loan today is 700, a little below 700. Just for context, 700 is in the middle of all credit scores. If you look at the entire distribution of all the credit scores in the country, 700 is right in the middle,
Did I understand correctly that it was a private, capital private market, you called it, that was providing home loans to the lower and a lot of the subprime loans?
Yes.
Was that market?
That was-
That's dried up now.
Zero now. So give you another, I like numbers for context. So subprime mortgage debt outstanding at the peak in 2007 was over, it's like 1.25 trillion. We're down to 250 billion, right? And it's going to go to zero,
Did that market include like local individuals that had capital in local markets, like in Florida, and was loaning to local people on homes? I mean,
You mean individuals?
I saw some of that when I was in Florida, where there was a woman had some capital, and so she went around and financed houses.
No, that's not this. These are loans that have been securitized, bundled and securitized by investment banks and investment houses.
I mean,
No.
some of it was done. I mean, people would set up like lending shops, but they would sell the mortgages off. So I mean, it was almost like they were like not a real estate agent, like an insurance agent. That's like the front person, not in a pejorative way for Allstate, right? But you're really buying it from Allstate. So in the same way, you're really, those mortgages are really eventually going to a security, right? The person you deal with is just sometimes the salesperson.
So like for context, let's talk about the structure. So what? Okay, go ahead.
This is the structure.
No.
Yeah.
No, but I mean, why? Maybe just unpack it one more level. What it is that Fannie and Freddie did? Why did they take the good mortgages? Why did the private sector?
Well, we're moving
take
there,
the-
Stacy.
great.
Okay, so here's 10 trillion. 1 trillion is FHA, VA, USDA. 1 trillion is private label securities. 3 trillion is banks. Let's talk about that, and then let's end with Fannie Mae and
Okay,
Freddie Mac.
gotcha.
Okay. So that's the structure of how I'm presenting this. Okay.
Yeah.
Okay. Does that make sense?
No, absolutely.
Okay. So the banks provide about $3 trillion in mortgages. That's what's sitting on their balance sheets. The banks generally make very high quality loans because they own the loan, right? They own it. So they're only going to make loans that they're pretty sure they're going to get paid back on. Now, in most cases, those loans are bigger loans. I mentioned Wells Fargo, Bay Area lending. They tend to make a lot of lending in the part of the market where the loans are too big to sell to Fannie Mae and Freddie Mac. These are so-called jumbo mortgage loans. They're non-conforming loans. The banks have continued to provide credit consistent with historical norms. So right now, they're providing about 10 to 15% of mortgage loans. So loans that are being made today to purchase a home, that's roughly consistent with what they've been doing over the last 5 to 10 years. So it's consistent with what they've been doing. They're not going to do any more than that. They're probably not going to do more than that because they too remember the recession. They don't want to have too much mortgage credit risk. They don't want to take on more than what they already have. And also there's some uncertainty that they have with regard to some of the rules and regulations. That's getting a little bit better over time. But they also worry about reputational risk. So what they're doing for the market today is pretty similar to what they've been doing for the last decade or so. And it's very unlikely they're going to do any more than that going forward. But the quality of the loans are pretty good.
They don't securitize securitize them? They just hold them?
They're the principal originators of loans, so they'll originate the loan, and then they decide what am I going to do with it. In most cases, they'll sell it to Fannie Mae and Freddie Mac. They'll sell it to FHA. They used to sell it to private label securitizers, but they can't do that anymore. And then they say, okay, these loans I like, the best loans, or loans I can't sell for whatever reason, because they're too big to sell to Fannie Mae and Freddie Mac, and they don't qualify for FHA. I'm going to hold on I'm going to own them. I'm going to hold them on my balance sheet. But there's a limit to how much they're going to want to do it. Yeah,
A portfolio loan, is that,
that's a portfolio.
so it's a portfolio loan, would you call that a hard money loan?
Hard money loan.
So like the guy in your neighborhood
They're all-
who's,
yeah,
They're all hard money loans.
yeah, but I mean, but the guy, like, so there's a term of art like real estate agents use. The guy in your neighborhood or in Florida who's
Yeah.
got the old lady with the money wants to
Yeah.
give a loan. Okay, so like real estate agent would call that, Wall Street would not call it that, but the real estate agent in town would call it that.
Hmm.
Okay, so just FYI.
But that's the nostalgic view that we have in the old days when you got a loan, you went to your local bank, you got your mortgage loan, they held it forever until it was paid off.
I don't,
That kind of market's gone.
And then when
The other
Uncle
thing
Billy
that we-
loses the money, then everybody comes because they remember George Uncle Billy.
Did we
Okay,
ever
but-
have
Yeah. Are we going back to that?
but Fannie, that hasn't really, has that really been true since the GSEs have existed? Didn't the GSEs change, this is, it's a wonderful life model?
Well, it wasn't really a wonderful life, was it? I mean, that was the Great Depression. It was a mess. And so out of the Great Depression was born the FHA. The FHA invented the 30-year fixed rate loan, and we can come back to that in a second in the context.
Didn't last through the 40s and 50s?
Pardon me?
Didn't last through the 40s, 50s, early 60s?
Still
Yeah, it
existed.
did. Yeah, but it wasn't prior to the Depression. The 30-year fixed rate loan is an invention of the Depression and FHA. FHA started the 30-year fixed rate loan. And let's talk about Fannie Mae and Freddie Mac quickly, and then we can talk a little bit about how our system is unique in the context of the global system. And then I'll shut up. So Fannie and Freddie are the major providers of credit historically. As I said, they account for half the mortgage debt outstanding, about $5 trillion. At the current time, though, they account for 60% of all the loans that are being made. FHA 30%, the banks 10% roughly at the current point in time. No private label securities being made. Fannie and Freddie, they obviously are part of the federal government now. They were private entities prior to the downturn. They had very little capital, so even though their losses were small, remember I said they had a 3% loss on their mortgages, smaller than everybody else, that was more than their capital. Their capital was so thin, so they got wiped out, and basically the government, what I mean by this is Phil, had to come in and take them over. You were there on that day, on
Yes,
that
I was.
day, yeah.
I'll tell stories later.
Yeah, I'd love to hear them.
Yeah.
Hey, big spender.
Yeah. That's cheering. He likes to hear
cheering,
people
yeah,
cheer
that's
for
right.
him every once in a while.
Yeah.
So Fannie and Freddie are now in so-called conservatorship. They're part of the federal government, and it was the willingness and ability of the government to step in and take them over that ensured that the mortgage market, the housing market, and by extension the economy didn't completely evaporate. So if the government had not stepped in and Fannie Mae and Freddie Mac had failed, there would be no mortgage credit, zero. The housing market would have completely evaporated. It already collapsed, but it would have completely evaporated, and it would have taken our economy with it. So it was important, critical, vital, absolutely necessary to step in and to ensure that Fannie Mae and Freddie Mac remained going concerns and that their operations could continue on.
When you say zero, I thought you had said that Fannie and Freddie did 50%. Now it's 60, but 50%. So wouldn't that be 50%? What am I missing?
Well, that's if they can operate. So they had very thin capital. They suffered all these losses on, still small by everyone else's standard, but too big for their capital. They were insolvent. They would have failed. If you fail, that means you don't operate. that zero mortgages would have been
But,
issued.
but 50%.
That's already made. They had 50% of the mortgages. They had over the years, they had insured 50% of the mortgages outstanding. But on this day, when they failed, they would stop insuring any mortgages. No mortgages would
So
get
the
originated.
incremental.
He's asking why would the other sources of capital dry up?
Well, private label securities was already dead, right? There was no Fannie and Freddie. The only source would have been the FHA. That would have been they would have become the market. They would have
And
been 100%.
banks.
The banks would have stopped lending too, because if Fannie Mae and Freddie Mac weren't making any loans, the entire housing market was going to go down and take the economy with it. So the banks wouldn't be making any loans either. They would not want to make any loans.
I mean, think about it. If
Why would you
there's-
make a loan in that kind of environment?
Yeah, if you're
Because it's a great opportunity.
Yeah,
No,
wait,
are you
wait.
kidding me?
If you're
Unemployment's going to
doing-
15%.
if you're doing a portfolio, your Acme Bank, and maybe you've been giving loans to Billy and everyone in the neighborhood who you know and trust, that's fine, and maybe Billy's a good credit risk. But then when everyone else in town can't get a loan, and you're the only bank making loans,
No, you wouldn't make a loan.
you're not going to make loans because every house in town is suddenly going to be worthless because it can't be sold because nobody can get a mortgage on it.
And remember, the banks
So
at that point in
I'm
time
not going to
too,
make a
right?
mortgage on it either.
I think just a structural clarification question. Why is it that Fannie and Freddie take the conforming loans and the private sector has to take the subprime loans? What is it about, just to lay the context of that, what is it about? So if they went to zero, why couldn't the private sector step in and play that role of Fannie and Freddie for the good loans? I think is maybe where he was
Well,
going.
Fannie Mae and Freddie Mac, by law, can only buy certain kinds of loans. These are called conforming loans. One of the key aspects of that definition of what a conforming loan is the size of the loan. So it can only buy loans of a certain size. That's actually the conforming definition of conforming loan is changing. Going back to your question about will the market ever go back to the way it was, the answer being no, in part because conforming loans will be so-called QM loans, qualifying mortgages. That's the rule to determine legal liability with regard to making a loan, whether the loan can be is affordable, whether it can be paid back. So there's laws that stipulate, what can Fannie Mae and Freddie Mac buy, but that's not relevant to
But
the
it doesn't-
question of why the private sector wouldn't step in the middle of the recession. The answer is because the private sector was completely panicked and running for the doors. They had no capital. Think about the banks that were failing at the time. Wachovia failed, Washington Mutual failed. These are big mortgage lenders. Goldman Sachs would have failed if it couldn't get a bank holding company charter and borrow from the Federal Reserve.
In the middle of the night.
Right, but when everyone was scared, Warren Buffett came in and gave a lifeline. Who was it? To Goldman Sachs or somebody at some outrageous amount of interest return.
10% dividend, yeah.
Right. So when no one else was willing to lend the money, he came in. Why wouldn't there be banks or FHA or somebody that would have done that?
There would be lenders who would do that, right? You can always come up with money. You're just going to pay for
No,
it.
but
Just not us.
No, that's not even the truth. The only reason Buffett did it is because he knew the government would step in,
Yeah, well,
right?
that's true.
If he felt that the government wasn't going to step in, there was no possibility he would have handed over money to Goldman Sachs, because Goldman Sachs would have failed.
But I
he
think,
knew that.
Are you asking why the local bank isn't going to give you a loan? Like,
What I'm struggling
loan?
with, and I apologize. What I'm struggling with is if Fannie and Freddie only do 50% of the loans, they do half. You're saying the other half, had they failed, would have shut everything down.
Except for
Stop.
FHA. FHA
So
would
that's
have.
30%.
Well, they would have been more. They would have been 100% of the market at that point, right? But the market would have been a lot smaller. They would have been 100% of the market. No one else would be lending.
So why couldn't
Yeah,
we
so
function
The
with
key
that?
thing is that housing prices are going to collapse.
Yeah, so that's it. So people
Yeah.
talk about not
What-
wanting to catch a falling knife. That's kind of the metaphor. So if you're a small bank, right? I wouldn't make a loan to Mark, even if he's going to put down 20% or 25%, if I think housing prices might fall another 30%, right? Because then he's going to walk away from his home. Or again, and remember this is in 2008 when people were just walking away from their homes, right? The unemployment rate, as Mark said, is going up. So that's the context in which, Fannie and Freddie disappear, right? Banks would look at it and say, look, those guys made the safe loans. Now, it turned out they didn't entirely make safe loans, but that's kind of their image. They made the safe loans and they got creamed, well, I'm not going to make those loans either because
Now,
who knows?
but you make an interesting point. So you're saying one way of thinking about what you're saying is, well, why? Okay, Fannie and Freddie are dead. They can't make any loans. The banks are too scared out of their minds. They don't have capital anyway, so they're not going to be making any loans. And we know the private label securities market is completely zero, right? Because they're getting completely wiped out. So that means the FHA could step in, right, and fill the void.
Make it
And in
killing.
fact, one of the proposals for the future mortgage finance system is that model, right? So everything is private, except you have basically an entity called the FHA or something like it, that if things go completely wrong and the whole world collapses and there is no private lending, this FHA would expand out and fill the void and provide the mortgage credit. So it's not, what you're suggesting isn't like implausible. It's not going to be very efficient, because going from all these other lenders providing all this credit to just the FHA, that's your pipe for getting all the mortgage. It's not going to work gracefully, right? It's going to be messy to try to make that work for all the potential buyers out there. The market's still going to go deeply south, but it's not implausible. That's one framework that's been proposed for the future housing finance system.
Thank you.
Yeah.
In the last few months, though, I've been hearing from banks in the state I cover that they want to privatize Fannie Mae and Freddie Mac, get the government out of the business. Is that going anywhere at all?
Well, that's part two of the conversation. And Phil's going to go in that in detail. The answer is no. That's not going to happen. Yeah.
So Phil, you
Yeah.
can just go home now.
Yeah. But they'll tell you why. That makes no sense. But
It does to Mr. Garrett.
pardon me.
It does to Mr. Garrett.
Yeah.
yeah, of course.
Yeah, true.
And in some ways, I'll talk about this later. That there's a sense in which the proposal from the House Financial Services Committee, the way people talk about it, including the press, doesn't exactly match the text of their proposal, which is kind of an interesting. Yeah, I mean, so when the press talks about Mr. Garrett's proposal, they say it's entirely private, but it still has the FHA, and presumably, like Mark said, the FHA's role would be bigger, and so it's. Yes, anyway, I've always been struck that people say it's a private market, but it's really not a private market because the FHA is there. And so anyways, the differences between the House and Senate approach, I think, are less vast than even the House puts forward.
Well, I'm not so sure about that. But
Yeah, anyway, so we might I think we're going to...
He's so iconoclastic in so many ways. Yeah.
We're all individuals.
Yeah.
So.
To also ask a very basic question, I apologize as well, but I'm just a little bit fuzzy on some of the overlapping boundaries here. The banks, if you can go to a bank and they will offer the loan, and then if it's a qualifying loan, they may sell that to Fannie or Freddie.
Yeah.
But I could also go to Fannie or Freddie directly, correct? If I was
No.
So I could either go to the FHA if I qualify for one of their loans, or I could go to the bank.
Well, let me take one step back. The loan is originated generally by a bank or a mortgage bank or some other financial institution. That institution, after they make the loan, decides, what am I going to do with this loan? Am I going to own it? So Wells Fargo owns a boatload of loans. Am I going to sell it? Who am I going to sell it to? Does it qualify for Fannie Freddie? Oh yeah, that does. And in fact, that makes more sense. So I'm going to sell it to Fannie and Freddie so they take the credit risk. Or if it's low income, low credit score, I can't get it to Fannie and Freddie, they won't buy it. FHA. Oh, let me do it FHA. So I'll sell it to FHA. Back in the boom times, when there was, Goldman Sachs or Bear Stearns or whomever packaging private label securities, that was another place I could sell it, right? I could sell it to them, and in fact, they were giving me a really good deal back in 2005. They wanted the loan, and I would sell it to them. But now I can't do that. That market's dead.
And so the banks have always been the first window.
They're the retail. They're dealing
The
with you and
retail.
me to make a mortgage.
And the government has never offered customers the ability to go
Directly.
There's no
no.
window for you to walk up to the government.
Got it, thank you.
Yeah.
And then just to get to Fannie, I'm sorry to belabor this point, but in that normal time, why, if it conformed, would you always sell it to Fannie and Freddie? Why wouldn't you sell it to Goldman Sachs if it conformed? That's
Well, in the boom times, people didn't always sell it to Fannie and Freddie. They did decide, I want to sell it to Goldman Sachs because it was so. Goldman Sachs and their investors were so euphoric and optimistic that they would provide a better deal than Fannie and Freddie. But that's rare, right? That's unusual. Usually, Fannie and Freddie will give you the best deal on a loan that is conforming, that meets their standards, because their costs are lower, right? And they can borrow more cheaply than anybody else, and they can borrow more cheaply because they were deemed to be essentially backed by the government, not explicitly but implicitly, right? So they could give the better deal, and you could get a better, what people would say, a better execution on that mortgage loan through Fannie and Freddie. So generally, you would sell it to them, but it's not always the case that you would.
If I'm off track, just say you're off track now. The Erskine Bowles other guy.
Whoa.
Bull Simpson.
Bull Simpson,
Bull Simpson.
yes.
We're going down a different track.
Am I?
No, go ahead, go ahead.
No,
go
because
ahead.
I was just
Yeah.
thinking about everything you all are discussing and thinking about Bull Simpson, the second they wanted to get the deficit under control. One of their suggestions was eliminating the second mortgage tax credit.
Yeah.
Yes.
You have a lot of individual people who are investors in the market individually. And I'm wondering, how does that play into the Fannie Mae, Freddie Mac sort of picture?
Yeah.
Does it or no?
It's not direct, no. I mean,
If I'm not-
no, they're, we as a nation subsidize housing, home ownership in lots of different ways. One way we did that, still do it, is through Fannie Mae and Freddie Mac, because if they have a backing by the federal government, that means their taxpayers are backing them, and therefore they can borrow more cheaply, and that's a subsidy to their shareholders, to their executives, and presumably some of that gets passed through to homeowners who are using their mortgages. Another way to subsidize home ownership is through the tax code, and there's lots of ways that happens, but the most obvious is the mortgage interest deduction. And Simpson Bowles, in an effort to raise revenue, said let's simplify the tax code. I don't think they proposed getting rid of the mortgage interest deduction, but scaling it back for second vacation homes, which seems kind of reasonable, but it's not a lot of money. At the end of the day, what is it, $30 billion over 10
Yeah.
years or something like that?
Mhm.
So it's small.
If you did it for first homes. it would-
Yeah, that'd be
Yeah.
huge. It's
Yeah.
$100 billion a year in
Yeah.
total, but
Yeah.
that of course is small. Let me quickly talk about Fannie, Freddie, FHA, 30-year mortgages, and how we differ from the rest of the world. And I can do that in 30 seconds. So,
And then we'll take a break. Once
Yeah.
you get through
Yeah.
that. Can I just throw in one question either before or after? What about the state housing agencies like Sony Mae in New York? Were they ever any kind of significant player? Are they now?
they play a small role. I don't have a number for you. They're obviously more geared towards so-called affordable housing. A lot of rental housing, some low-income single-family housing, and they help. That's another way we subsidize home ownership, right, through the state housing finance authorities. So they would be able to issue bonds more cheaply, use that money to help finance, a multifamily building for low-income households, that kind of thing. They still operate, although they also, in the current context, have been neutered because investors are much less interested in their bonds, and some of the tax subsidies have waned, so they don't have as much. They're not participating to the degree that they have historically. So our system here in the U.S. varies significantly from the rest of the world in that we have a 30-year or 15-year fixed rate loan that is prepayable. That is, you can refinance that loan if mortgage rates fall. No one else in the world has this. The only exception to some degree is France, but France has long-term fixed rate loans because the loans are not prepayable. You can't refinance. So they take away that so-called interest rate risk. Denmark, so all 7 million Danes, have a 30-year fixed rate loan. They have a really different but fascinating mortgage finance system that, if we were really creative, we'd be talking about here in terms of, adopting it here. But it's small. Those are the only folks that have. If you go to Australia, you go to the UK, you go to Germany, you go to Mexico, go to Canada. They're mostly adjustable rate mortgages of some flavor or not. So we have a 30-year fixed rate loan. Just for context, 75% of all the mortgage debt outstanding, so 7.5 trillion, is fixed rate debt, 15 or 30-year fixed rate debt. 25% is adjustable rate. So we like 30-year fixed rate loans. Now, it's a very reasonable debate from an economic perspective whether that's a good thing or a bad thing, from an economic perspective. But it's irrelevant from a political perspective because we, the collective we, like our fixed rate loans. We want them. So whatever system we devise has to be able to deliver a 30-year fixed rate loan, prepayable, at an affordable interest rate, so that 75% of mortgage borrowers can afford a fixed rate loan.
And that 30-year fixed rate loan rose with the dawn of GSEs.
In the current environment, because the GSEs always, those are mostly, vast majority are fixed rate loans, and because the private label securities market is zero, 90%, 95% of all the loans today being made today are long-term fixed rate loans, 30 or 50. There's only 5-7% that are adjustable rate, very low. It's also, people can get the 30-year fixed rate loan is so low. It's even with the run-up in interest rates, still 4.25%, 4.5%. By historical standards, that's very low. And people also are, obviously concerned about rising interest rates in the future, so that makes them a little nervous about getting an adjustable rate mortgage today. Now, the only reason we can deliver, why we're different and why we can do this, is because investors who buy these securities that are guaranteed by Fannie and Freddie, the FHA, believe that they are taking no credit risk, that the government is standing behind these loans. So if these loans fail, if the world goes to hell and these loans fail, that at the end of the day, if things go badly wrong, they'll get their money, that the government will provide them the money. Historically, before the recession, before Fannie Mae and Freddie Mac were taken over and they were part of the private market, this could work because people implicitly believed that the government would step in. There was no explicit backstop, but they implicitly believed it. And they obviously were right. When the recession hit, the government stepped in and backstopped the loans. Now, by definition, because the Fannie Mae and Freddie Mac are part of the government is explicitly providing this backstop. And in the future housing finance system, which Phil will discuss, we're trying to design a system where the government is there to provide a backstop in a rational way so that we can still provide 30-year fixed rate loans. Now let me quickly explain the reason why you need the government to step in to take that credit risk. So when you if you're an investor and you're investing in a mortgage, either through a mortgage security or a mortgage, you're taking a number of different risks, but the two key risks are the risk that this loan will not get repaid, right? That's a credit risk, that the homeowner loses his or her job and can't make the mortgage payment and they default. That's credit risk. And the other is interest rate risk, because you're gonna be buying a mortgage or security at an interest rate, and interest rates go up, market rates go up and down, and that changes the value of your security, right? So if I buy a security at 4.5% and mortgage rates go up to 6%, right? That's going to affect the value of my mortgage. There are very few investors on the planet that are willing to take both risks. That's very hard to do, very complicated to get right, and so there are very few investors that do that. And there's debate about that as well, whether that can change. But there are investors who are willing to take credit risk, and there are investors who are willing to take interest rate risk, but not both. So if you take away the credit risk by having the government say, I'm going to backstop that, you're going to get your money if the mortgage defaults, then you can find investors that take the interest rate risk, and it all works, and you can have a 30-rate fixed rate loan. Right. But it only works if the government, someone that everyone believes can make good when things go bad, ensures that there's no credit risk to that investor. So, for example, I'll give you an example. Central banks buy a lot of mortgage securities. As part of quantitative easing, the Fed's been buying a lot of mortgage securities. But in general times, they buy mortgage securities. Pension funds buy mortgage securities. Sovereign wealth funds buy mortgage securities. But the only reason they buy it, because they know they're not taking any credit risk. If they thought they were taking credit risk, they would not buy it. They would not be willing. They would not be, even by their own fiduciary guidelines,
Right.
They would not be able to buy it, right?
I think that's a really important piece of this puzzle. So an investor is a bondholder. Okay, so there are a lot of entities, like the pension funds you mentioned, like the sovereign wealth funds, who have guidelines, some of them imposed by the government, that say a certain amount of your investments have to be safe. Okay, AAA, whatever the definition is, they have to be safe. So what's a safe investment? One safe investment is one that you know the U.S. government's going to stand behind, and that's a mortgage-backed security or treasury bond. This is really shorthanding. So there's a lot of investors out there who have to buy stuff like this. Okay, and so they're putting money into our mortgages.
Can I ask a naive question? You said that very few investors are willing to take both risks, right? So the government has to be a backstop. Well, if a bank has issued the mortgage, right, to a retail investor, why do I need the investor? Why do I need to worry about investors buying and packaging these?
There's not enough money. The banks don't have enough money to make loans to all of us and keep the loans on their books.
They could do that, but they would ask for a much higher interest rate to do that. So on the loans they generally own, in most cases, they're incredibly high quality, very wealthy households with very low debt to income ratios, very high credit scores. A lot of them are adjustable rate mortgages, so they don't take interest rate risk, right? The interest rate on the loan adjusts with changes in market rates. So again, they're not taking both credit risk and interest rate risk. They're taking the credit risk, but they believe the credit risk is low because they're taking mortgages that are high quality.
So investors are, in essence, subsidizing a lower interest rate for homeowners?
Of course. I mean, if there's more investors willing to invest in the mortgage,
That's the whole deal.
Right? If
That's
there's
what's
bigger
going
demand
on.
for the mortgages, the
Right.
cost to the borrower goes down, right?
That's how the Fed.
yeah.
You might just explain then how the Fed.
Oh
how
yeah,
the Fed's
here,
action
oh
works.
that's a good
Yeah,
point. So
yeah.
right now, one of the biggest investors in mortgage securities, of Fannie Mae and Freddie Mac, is the Federal Reserve Board, right? So the Federal Reserve Board is buying $45 billion a month in mortgage-backed securities, and so that's a demand for those securities. I mean, the Fed is an investor in those securities, and because they have demand for those securities, that's driven the interest rate down, and that's one of the key reasons why mortgage rates are as low as they are. There's a lot of debate about how much lower. That's a question that there's no. You have to tease that out of the information and data that you have, but that's why one of the reasons why we still get a 30-year fixed rate loan at 4.25%.
So the Fed's meeting today. They may or may not come out and say, we're not going to buy $45 billion a month in mortgages anymore. We're going to buy less. And people are prepared for that, like for the shock. That'll happen this month, maybe next month, maybe in the spring. It's going to happen really soon. And the market writ large is sort of braced for this shock of this that could potentially jack up interest rates. I don't know. That might be one
Yeah,
reason
June.
that they're already starting to creep
You might
up.
even just talk about
I
it
don't
in
know.
June when Bernanke
Yeah.
hinted at the taper.
Yeah.
What happened?
What
with
happened?
rates
Yeah.
last year.
Yeah, so just to give you a sense of how important this is, the Fed buying and not the effect on interest rates, to your point. So back last spring, Chairman Bernanke started talking about the possibility that the Fed would wind down its buying, the tapering. When he did that, interest rates rose very sharply, mortgage rates rose sharply. So if you go back to, say, March of 2013, at the low, the 30-year, you get a 30-year fixed rate loan for you probably could have gotten about 3.5%, 3.25%,
Yeah,
3.5%.
less than 3.5.
Yeah, and now it's probably closer to 4.5%. So they rose, and at the peak back last summer, early fall, they were going for 4.75%. So mortgage rates rose a full percentage point, maybe 1.25 in a 3-month period
boom.
around that period. Now, there's a lot of debate as to why rates rose like that and whether it had to do with directly with the tapering. I won't go into it unless you want to go into more detail, but that is an important debate because it goes to whether the Fed is going to be able to manage interest rates higher going forward without disrupting the housing market and economy and the recovery.
But the point is, that's $45 billion less money. When it happens, when it starts to happen, it'll be every month less. One less investor in
But-
mortgages.
But this is an important debate though,
So who, is somebody gonna come in then and say, we'll start buying that 45 billion? We don't,
Yeah, although that's the concern. The theory is that it's not the 45 billion that matters, right? It's the amount of mortgage securities that the Fed already owns.
yeah.
So that's a very important distinction because it goes to whether you think the Fed is going to be able to manage the increase in interest rates in an orderly way or not. If you buy into Lorraine's perspective that all of a sudden they stop buying 45 billion a month, that's going to cause that. If you buy into that and that's the mechanism, that would suggest that mortgage rates are going to rise a lot when they stop buying. But that's not the prevailing wisdom at the Federal Reserve. They don't think that's the way this works, the mechanism through which it
And
works.
it's not gonna be, they're not just gonna shut it off, it's tapering. Slow.
Is this a good time for a break?
Sure.